Great. Okay, well, thanks very much for getting things lined up, and thanks to Houston Galveston Area Council and the Texas Association of Regional Councils and the National Association of Regional Councils for sponsoring this session. I was joking with our colleagues in the chat room before that I'm one of those folks who understands what a council of governments is, because I started my career at one and then subsequently joined another one. So understanding regional planning and development and cooperation is something that's hopefully tattooed into me. And certainly what we're going to be talking about here has broad implications for organizations that play such an important role in the implementation of federal aid programs. Now, we titled this session just "Where Are We Now?" And focused on OMB's revisions to Title II of the Code of Federal Regulations. That's just the latest event in a set of events that have occurred during 2020 that I think most people feel like they've been drinking from a fire hose in terms of developments associated with federal aid. But if we kind of step back for just a little bit and look at the big picture of where these requirements come from and how they've evolved in the last several years, I think it sets a good grounding for what has changed just in the last month or so. If we hit the first slide, Title II of the Code of Federal Regulations, that's entitled Grants and Agreements. And it is a compendium of all the federal rules that affect grants and cooperative agreements. There's an analog to that elsewhere in the Federal Code of Regulations, and that is something called the Federal Acquisition Regulation, or the FAR, which deals with how federal contracts are operated. And it's 7 thick books of regulations, so be glad we're not talking about that today. But Title II is a little thinner, but contains some of the fundamental sets of requirements that you have to contend with as a participant in the federal assistance business. Now, the policies that are there are ones that are issued by the Office of Management and Budget, which of course is a part of the Executive Office of the President. But in addition to that, there are issuances that have been promulgated by individual federal agencies that track some of the OMB requirements. And so when you get an award directly from the federal government, it's going to cite the overall OMB requirements contained in 2 CFR 200, as well as a set of agency regulations, much smaller, which deal with things that are unique to that particular federal agency. I'm sure many of you are familiar with the U.S. Department of Transportation because of your role in transportation planning activities. Well, 2 CFR 1200 is where DOT parks its additional supplemental requirements. So the notion is that this manual, or this volume, which is probably 700 or 800 pages long now, is going to be a document that will be referenced in many of the things that you deal with. Now, the important thing about the Code of Federal Regulations is that it is executive branch policy that is developed by the executive branch agencies pursuant to something called the Administrative Procedure Act. And that's a statute that was passed back during the New Deal and enabled federal agencies to issue policies based on delegated authority from the Congress that had the force and effect of law. It's where we get, for example, the Federal Register, which is kind of the daily diary of what the federal executive branch is doing on any given day. And things that are published in the Federal Register in proposed regulation form are subject to review and comment by the general public, and the federal agency involved is expected to review those comments, incorporate them as needed, and then codify the regulation in the Code of Federal Regulations. So this particular process is something that has taken place extensively over the last 5 years, related to what a lot of you probably remember as being Office of Management and Budget circulars. So how we got here, if we can turn to the next slide, I don't want to go into a big, deep history lesson here, but some of the major events associated with particularly 2 CFR 200, or what is known now as the Uniform Guidance, started back during the Obama administration with a set of presidential directives followed by 2 iterations of proposed regulations in the Federal Register. Ultimately, effective December 26, 2014, 2 CFR 200 consolidated a number of existing OMB circulars into a single cohesive whole. Now, as if to prove that something that was developed by a committee of federal agencies wasn't perfect, something else came along in that process, and that was a set of interpretations contained in something called the CFR Frequently Asked Questions. CFR standing for Council of Financial Assistance Reform, an interagency group that OMB formed to help put together this whole set of things. Well, one of the things that OMB did was they made a commitment into CFR 200 to conduct a review 5 years out from the issuance of the regulation. So that particular date fell at the end of December 2019. And as a result, on January 22nd of this year, OMB floated a set of proposed revisions to 2 CFR 200, as well as some other things that related to Title II, asking for a 60-day comment period for organizations to weigh in on the subject. And as you can see from the slide, OMB got 215 separate sets of comments with more than 2,500 individual suggestions about how the regulation should be dealt with. Now, it was about that time, of course, that COVID-19 reared its ugly head, because the comments were due on March 23rd, yet on March 13th, the president issued a national emergency declaration, which triggered a whole bunch of additional kinds of things related to federal funding. And we're going to talk a little bit about those things. But OMB's main objective back before COVID-19 reared its head was to try to align the regulation to CFR 200 with a number of revised sources of authority that had surfaced in the interim period of time. Some of those sources of authority were statutes that were enacted by Congress, particularly as it related to procurement using federal funds. A number of other ones came along, particularly after January of 2017, with executive orders that President Trump has issued that have had an impact on the federal assistance policy regime as well. Now, turning to the next slide, what's the verdict? First off, OMB limited the proposed changes that they developed in January, or when they published it in January, to a limited set of purposes and subjects. They didn't throw the entire regulation open to scrutiny or comment. And that has been a source of some frustration to the recipient and subrecipient community. The fact that there were things that were called to their attention that various parties felt needed to be fixed, but didn't get fixed. Now, OMB deemed those proposals out of scope and that they were not accepted, but they did throw a piece of meat to the grantee community in the preamble to revisions that they published on August 13th of this year, promising additional further consultation with stakeholders and possible additional revisions. Well, the permanent party at OMB are the people who are probably most involved in all of this. But of course, they have to take their direction from whoever's in charge of the executive office of the president. So the fact that we have an election in another less than 4 weeks may impact OMB's willingness or need to conduct consultation. Now, the revisions to 2 CFR 200 and other sections are covered on the next slide. And these are all matter. Well, I should say all matters. There's at least one item that was developed that isn't going to affect you, and that is something you should be glad about. That's 2 CFR 183, which is an implementation of a statute passed by Congress called Never Contract with the Enemy. And this is creating a certain amount of stir among non-governmental organizations headquartered in the United States who perform overseas using State Department and USAID money. So that one, while it was part of what got released last month, or actually in mid-August now, that's something that you don't have to deal with. But 2 CFR 25 is something that a lot of you are already familiar with. It's the set of requirements that deals with the System for Award Management, which is the database that the federal government uses for a variety of purposes in dealing with federal assistance, and the place where the requirement for a uniform identifier number, or DUNS number, is lodged. 2 CFR 170 is the set of requirements that deals with the Federal Funding, Accountability, and Transparency Act, also known as FFATA. Its actual nickname is the Coburn-Obama Act, named for the 2 Senate sponsors who came together from probably opposite ends of the political spectrum to support an activity involved with accountability and transparency for federal funds. The basic requirement there is that a single searchable database be available to the public and other interested parties having to do with who has federal funds. And in order to make that database work, there are reporting requirements that are particularly imposed on what are known as pass-through entities. And of course, in many cases, councils of governments and regional planning councils and the like may be pass-through entities in some federal programs. 2 CFR 200 is the kind of the big Megillah in all this. It is the uniform administrative requirements, cost principles, and audit requirements. So it's a consolidation of a bunch of existing OMB circulars that by and large applied separately to different kinds of performers, to state and local governments, colleges and universities, nonprofit organizations. Now, the revisions to these sections were published in the Federal Register on August 13th of this year. They were made effective November 12th. So there's a 60-day hiatus. We're in that hiatus right now. And only a couple of the sections that were revised took effect immediately. So there's some implementation time for organizations affected by the changes to get ready for them. And so the idea here is to kind of, give you a heads up about some of the things that you may want to be looking at in the upcoming weeks. Now, to back away for just a minute to the next slide, what I refer to as in case you missed it, 2 CFR 200, the big picture. Basically, this regulation, which is probably 150 pages long, is divided up into a number of sections, so-called subparts. Subpart A is pretty obvious definitions, and there are obviously some things about that have some impact on how you do business. Subpart B, the general requirements, which I like to refer to as the housekeeping section, it talks about who the requirements apply to, how they are communicated, and very importantly, how exceptions to the requirements are handled. Subpart C, pre-federal award requirements and contents of federal awards. That is primarily addressed to the feds themselves. But I hardly recommend that recipients and subrecipients get familiar with what's in there, because this is how federal officials are expected to behave when they are administering federal grants and cooperative agreements from their side of the table. There are some pretty significant pieces of that document. For example, there is a whole discussion of how so-called pre-award risk assessment is going to take place. The idea that before you get a federal award, you're going to be looked at from an organizational standpoint with the idea is, are you somebody who's trustworthy enough to handle what the federal government regards as a fairly risky proposition? In addition to that, there's a template contained in Subpart C that identifies the elements that must be present in a federal grant agreement. Now, OMB would love to have every federal agency issuing grant agreements that look exactly the same. That's kind of their general mantra. But most of the federal agencies don't go along with that. What they do is package it their own way. But if you scratch the surface, you're going to find the elements that are present when in Subpart C of the regulation. When we move to Subparts D, E, and F, that's where we get to the critical mass of requirements that are going to apply to you. And obviously, many of you have been dealing with this for several years now, but there's still a certain amount of learning curve and familiarity gaining that is present. Subpart D deals with post-federal award requirements, what used to be present in OMB circulars A102 and A110 for governments and non-governments respectively. So there are, for example, in Subpart D, substantial discussions about the kinds of management systems that you have to have in place. And one of the areas that's been tweaked with the new requirements that came out in August has to do with how you do purchasing using federal funds. Another part of Subpart D that was affected is the emphasis on timely closeout of federal awards. So we're going to get into each of those in more detail in just a few minutes. Subpart E is the cost principles, the rules on what you can charge to the government, what you can't charge, and how the costs are to be documented. Now, there are a couple of major changes that have taken place in this section, one having to do with what's known as the general tests of allowability, the other having to do with certain selected items of cost that have been redefined or defined for the first time in terms of allowability or unallowability. Finally, Subpart F is the audit requirement. This is what replaced the famous OMB Circular A133, implementing the Single Audit Act of 1984 as amended. Now, moving over to the next slide, OMB's original objectives with all of this consolidation was to put everybody who was affected by federal funding under the same roof and to harmonize the requirements that had been slightly different in some of the sector-related circulars. So the idea would be to treat governmental units, institutions of higher education, and nonprofit organizations in roughly the same way. I say roughly the same way because even with that in mind, there are some fundamental differences, particularly in the indirect cost recovery area. So the idea here was to harmonize the requirements, make them simpler, and reduce some of the burden. And as I suggested earlier, the COFAR frequently asked questions surfaced almost immediately because there were things that either weren't particularly well drafted or that raised additional concerns on the part of the recipient community. Well, one of the objectives that OMB had with the revisions that came out in August was to incorporate into the regulation some of the interpretations that had shown up in the frequently asked questions. Now, moving on to the next slide, some of the key themes that were present here, and I think it's important to re-emphasize these because they are still matters that are sources of, shall we say, controversy or at least disagreement among the players in the federal assistance business. Mandating content and timing of federal program announcements was certainly one thing that OMB wanted to do. The idea being that organizations who were planning to seek federal funds needed to be given sufficient information to make an informed decision about whether or not to apply. And this manifests itself primarily in the displays that show up in grants.gov, something that I'm sure many of you are familiar with in terms of searching for opportunities for federal grant funding. A second component was ensuring better awarding agency review of financial risk and application merit. I alluded to this a moment ago, but the idea that prevention up front is superior to audit at the back end. And you can see the fingerprints of the federal inspectors general all over these requirements. A third thing, and this is really important, is the possibility of what we might call differential accountability. The idea that not all grantees need to be treated the same way. Some grantees, because of their experience and capability, should be given greater flexibility in administering funds. And there is some tangible evidence of that in the regulation. Other grantees, because they've either had problems in the past or problems are anticipated, may need greater scrutiny. And so designating an organization as a high-risk grantee or imposing special conditions on them that don't go on all other grantees is something that's permitted as well. A very critical thing that is part of the requirements was to provide clearer instructions for robust management and monitoring of subrecipients. This is really where the rubber meets the road in terms of the requirements, because the discussion about the distinctions between subrecipient and contractor relationships, which are fundamental, the kinds of things that need to be done by a pass-through entity to review the potential risk that a subrecipient might represent, and the specific expectations about what kind of oversight or monitoring needs to take place and what is discretionary in that area are really right at home in terms of what councils of governments need to be concerned about. Because, of course, many of you are subrecipients in funds that may come through the state government where you're located, but you may be turning around and becoming a pass-through entity yourself, dealing with lower tier entities such as your member local governments or nonprofit organizations or colleges or universities that are within your region. So this remains a big deal. Finally, better balance between accountability and results. Now, it's difficult in many cases for grant programs to be tied to specific outcomes, because many of the things that organizations are working on using federal funds don't lend themselves to clear deliverables. And a lot of things can interfere with that delivery because of the societal problems that entities are wrestling with. And that's certainly become even more clear during the coronavirus pandemic. Moving on to the next slide, key instructions for recipients and subrecipients. I think it's fair to say that dicing up the activities that are discussed in 2 CFR 200 into the major subjects that are shown on this slide is a good way of looking at things. A critical aspect of the regulation has to do with system standards. Now, the concept of system standards is that the federal government recognizes that most organizations that are going to be spending federal funds are spending a lot more of their own money during their fiscal periods. And so the idea of imposing requirements on them related to things like financial management, purchasing, property management, and the like doesn't make a whole heck of a lot of sense. Instead, what the government has done, and this has been true since the 1970s, is say that your system for administering federal funds must meet certain basic standards or a floor below your public administration. And if your system meets those standards, it's satisfactory. If it exceeds them, that's dandy too. But if it doesn't meet the standards, bring your system up to that level. And this, of course, is something that probably is not anything that most councils of governments need to worry about, but it's certainly something that some of your member governments are still wrestling with, where their capability to handle some of the federal fund management responsibilities might be needing to be shored up. And a lot of you that provide technical assistance in that arena know this as well as I do. Limitations on the award have to do with restrictions related to the expenditure of funds, and that's where the cost principles come into play. As part of my practice, one of the things I deal with pretty regularly is something called audit resolution, which is helping organizations who have critical audit findings try to resolve those in their favor. I can tell you that the tools for dealing with that are contained in the cost principles. And arguments about cost allowability are when federal grants management becomes a contact sport. Reports and records. Obviously, considerable concern here about how communication with awarding agencies is going to take place and what kind of information needs to be retained and accessible in the hands of a recipient or subrecipient. Enforcement, what are the things that can be done if things go wrong? And in progressive order of discipline, the federal government provides a discussion of that. My experience is that usually when written warnings are submitted to a recipient or subrecipient, that usually is enough to motivate and avoid some of the more serious tools that are available to an awarding agency. And then finally, closeout and continuing accountability. What happens at the end of a project or program which lives on within those activities? Now, the next couple of slides deal with the life cycle of a federal grant. And I'm not going to belabor the point here because I still have a lot to cover that relates to the new stuff. But I think that the way to look at the requirements and array them from an organizational standpoint is to recognize that somebody within your organization has responsibility for the events that go on throughout the life of an award. The bigger your organization is, the more likely those duties are diced up into smaller pieces. But taking a look at the pre-award activities, for example, solicitation is the announcement of the availability of funds. In formula grant programs, that's done by notice to the eligible recipients. In discretionary programs, that's where grants.gov comes in. Application involves the submission of a request for funding. One of the things that kind of drives me crazy is when I hear a federal grant recipient talk about bidding on a grant. You're not bidding on a grant, you're applying for one. Contractors bid on contracts. They're submitting an offer to the government. In the case of a grant, the government's the one that's making the offer. Awarding agency review. Again, I point out that this is something that OMB has ramped up substantially. An ounce of prevention is worth a pound of cure is their notion. And finally, the agreement itself. And Please don't call it a contract. It is a grant agreement or a cooperative agreement. The difference being a cooperative agreement is a grant where the federal government's involvement during performance is substantial, but it's still an assistance award. What does that agreement give? It identifies the dollars that are being awarded, the time for performance, and the requisite requirements that go with the award. Now, something else that surfaces when we turn to post-award is that a lot of people have a misunderstanding about the concept of having a cost reimbursable award. Having a cost reimbursable award has nothing to do with when payment shows up. It has to do with how we settle up at the end of an award. Well, one of the things that has been introduced into CFR 200 to a greater extent than ever before is the concept of a fixed amount award. Some of you who've been unfortunate enough to have to deal with the Federal Emergency Management Agency may have experienced fixed amount awards, but other federal agencies are just now dipping their toes into that kind of an arrangement. But the lion's share of federal awards in the assistance area are cost reimbursable, meaning that the settlement of the award is based upon the claim of allowable cost. That claim is memorialized in a financial report, but the underlying documentation is retained at the recipient or subrecipient level, and that's one of the reasons why we have audits. So the events that you see on this slide about post-award activities are the sequence of things that are supposed to be taking place. Performance of the approved project scope begins with the authorization of the grant. Incurrence of allowable cost involves the obligation of funds to pay for those kinds of performance activities. And that's when the issue of drawdown of cash payment comes into play. Disbursement of that cash is supposed to take place as quickly as possible after the drawdown occurs, minimizing the time elapsing between transfer of funds and disbursement. And the amounts drawn are supposed to be as close as is administratively feasible to the amount that actually will have to be dispersed. Documentation of the transactions means creation of the books and records that will show that allowable cost for eligible activities took place. And the reporting of claims is where the rubber meets the road. Many of you who have direct federal awards, somebody in your organization is filing the standard form 425, the federal financial report. And block 13 of that report says, and I think I can quote it accurately, I certify to the best of my knowledge and belief that all data in this report is true, complete, and correct. But there's another sentence. It says, I understand that any false, fictitious, or fraudulent information may subject me to civil, criminal, or administrative penalties. And then there's a citation to Title 18 of the United States Code. Title 18 is the federal criminal statute, and the citation is to something called the False Claims Act. Next time you see a story about Lieutenant General Michael Flynn, think about the False Claims Act, because it isn't just related to false claims about monetary matters. It's a false statement made to government officials. So this is why the people in finance act like they do. Now, after the award is over, on the next slide, we've got closeout, which is something that's getting a great deal of attention from Congress, in part because of the concern that funds that have been obligated to a particular grantee are sitting idle because the grantee has run its course in terms of the period of performance, but the federal agencies haven't necessarily de-obligated the remaining funds. And the Government Accountability Office, GAO, has done several reports that were scathing about federal agencies' failures in that area, with billions of dollars that could have been and could still be recovered under those circumstances. But as you can see from the slide, there's continuing accountability that goes on, again, documented in 2 CFR 200, having to do with records retention and access, disposition of grant and sub-grant acquired property, and the federal awarding agency or pass-through entities' ability to audit and to disallow cost. So the fact that you have a single audit taking place based on your fiscal year doesn't preclude an awarding agency from coming in later on and looking even closer as a result. Now, that's about as quick as I can do an overview of what already exists and has since the end of December 2014. But let's turn our attention to more current event matters. And the next slide is headed Government by Horror Story, because there's certainly a lot of that going on. The media picks up on federal fund matters, in many cases to the exclusion of discussion about local revenues. And with COVID-19 and the passage of the Coronavirus Aid, Relief, and Economic Stability Act, the CARES Act, there's been even greater attention to that. Another acronym you need to be aware of is the PRAC, the Pandemic Recovery Accountability Committee. That is a club made up of 21 inspectors general from the federal agencies whose funds predominate in the CARES Act. And if you go online to www.ignet.gov and Google PRAC, you will find that they've already been spending time doing audits. Certainly the federal government's budgetary pressures have blown the top off of things because of the response to the pandemic, and that's not going to go away. Quality of single audits is another matter that is of great concern to the federal government, in part because there have been reviews of the work done by non-federal auditors, mostly from CPA firms, to determine whether they've been doing sufficient work on federal funding to justify the conclusions that they've drawn. And I know, for example, that a number of regional organizations have been subjected to what's known as quality control reviews, where their independent auditors' work papers have been scrutinized closely to see whether the findings that they've rendered or the findings they haven't rendered are called for. One of the things that OMB has determined with the issuance of the revisions on August 13th is that they are charging the inspectors general with a comprehensive review of single audit quality to be taking place in 2021. The last time the IGs did that, they took a sample of 40,000 audit reports issued in a single federal fiscal year and reviewed them in detail with a statistical sample. The interesting or disturbing thing about that is they came back with a statistically valid finding that 51% of the single audits were substandard. So there's a lot of concern in the federal government about the quality of the work that will be done, particularly with the kind of volume of federal funding that has come along with the CARES Act and provided even greater challenges. Certainly federal audits conducted by the offices of inspectors general are going to continue under those circumstances. And one of the ways those audits get enhanced is with the inspectors general hiring certified public accounting firms under contract to them, in which case those folks are going out essentially as being deputized by the inspectors general. They want to prove they were there. Finally, whistleblowing is alive and well, and so-called qui tam or qui tam lawsuits have to do with whistleblower arrangements where, under the False Claims Act, a party who has information that the federal government doesn't have can file a lawsuit on behalf of the federal government. The lawsuit goes under seal, and the party who is accused of wrongdoing doesn't even know they've been sued. Well, the bottom line here is if the government ends up recovering funds under a qui tam lawsuit, the relator, the party who brought the lawsuit, gets a percentage of the money. And there's a whole cottage industry of activity out there in that particular environment. I probably don't have to tell you that congressional oversight is also a challenge that exists, particularly when we have a divided government like we do right now. Now, as I've said earlier, COVID-19 has intervened in all this. And the next slide captures some of the developments there that you need to be aware of. OMB, almost on the heels of the president's declaration of a national emergency, issued several memoranda that provided administrative flexibility in the administration of federal grant funds. Memorandum 20-11 applied to organizations whose activities directly impacted coronavirus interventions. In other words, healthcare and research organizations were affected by that. But almost on the heels of that, just 10 days later, OMB Memorandum 20-17, OMB used their authority to grant class deviations from 2 CFR 200 when those deviations did not collide with statute. And the 2017 provided within the period March 19th to June 18th considerable flexibility. Now, in order for that flexibility to be manifest with you, it's something that your federal awarding agency or your pass-through entity needed to communicate. In other words, you didn't automatically get greater flexibility or modifications to your award unless that kind of thing happened. So, the point here is that, prior to March 19th, you would have been following 2 CFR 200 in its entirety. Between March 19th and June 18th, you would be following it in partial based upon whether or not your awarding agency implemented those flexibilities. And on June 18th, OMB issued Memorandum 20-26, which clawed back some of those administrative flexibilities, but kept a couple of them in place. And unfortunately, that memorandum expired on September 30th. And despite the fact that OMB was approached by a number of national associations and other parties urging them to extend those flexibilities, no action has been taken related to that. So my point here is that those dates, March 19th to June 18th and June 18th to September 20th, September 30th, relate to situations where you maybe have been allowed to do something different than what 2 CFR 200 provided. Now, one other place I should stop in terms of the COVID-19 intervention, and that has to do with something known as the Coronavirus Relief Fund. That is a $150 billion package that was part of the CARES Act that distributed funds by formula to each state and territorial government and direct allocations to local government jurisdictions around the country who have in excess of 500,000 residents. There are 171 units of local government nationwide that got a direct allocation of coronavirus relief funds. 22 of them are in California, 17 in Texas. There are actually 7 states, I believe, where there was no jurisdiction that got a direct allocation in that situation. So the state government in those states is where the coronavirus relief funds are being administered. Now, the important thing about this particular pot of money, and it's obviously very large and it's being spent as we speak, is it was expected to be related to expenses that occurred between March 27th, which was the date of passage of the CARES Act, and December 31st of this year. The Treasury Department, presumably in consultation with OMB, established that 3 portions of 2 CFR 200 were going to apply to those funds. Section 200-303, dealing with internal controls, 200-330 to 332 on subrecipient management and monitoring. So again, this is the kind of stuff that's right in the wheelhouse of regional organizations as intermediaries in many federal aid programs. And finally, the audit requirement in 2 CFR 200 subpart F, the single audit requirement. Now, I will tell you that there are still some shoes to drop related to the audit requirement. On August 18th, OMB rolled out its annual compliance supplement for single audits. This is an audit guide that they update annually. It's a rather large document, and it is part of 2 CFR 200. It is Appendix Roman numeral 11. Well, OMB brought out what they could on August 18th, but they are planning an addendum to the supplement, if you can get your head around those words, that will probably be released sometime later on this month or in early November. Independent auditors, whether state auditors or CPA firms, are waiting with bated breath for that document because it's going to explain to them how they are to audit most of the COVID-19 funding, including the Coronavirus Relief Fund. So, this is something to keep your eyes on the horizon about. Again, OMB is pretty close to the vest about when they're going to release things, but the rumor has it that the end of this month or early next month would be the timing for that. Now, let's turn our attention to the things that did get changed in the issuance that came out on August 13th. The next slide focuses on, again, just the summary of the events that brought the revision to fruition. The notice of proposed rulemaking in January, 60-day comment period concluding at March 23rd. The revisions actually issued on August 13th with an effective date of November 12th. Now, one of the things that's going to drive you a little crazy, and it's not something that I did, so please don't blame me, but OMB decided to renumber any number of sections into CFR 200. So a lot of the citations that you've gotten used to in your grant agreements and other places are going to change. And the full integration of the changes that were released on August 13th with the existing requirements that were not superseded is all going to occur after January 1st, 2021. This is because the National Archive, which runs the Code of Federal Regulations, revises the volumes of the code in sequence during the calendar year. And so during the first quarter of each year, volumes or titles 1 through 12 get revised. And so that takes care of when everything is fully integrated. In the meantime, turning back and forth between the existing regulation and the regulation that's been revised will be a necessary evil. A number of the frequently asked questions have been superseded by language that's now included in the regulation. This is particularly true with respect to indirect cost recovery and the use of something called the de minimis indirect cost rate. There have been some key definition changes. Those of you who've gotten used to referring to the Catalog of Federal Domestic Assistance Number, or CFDA number, are going to encounter a new term called the assistance listing. My experience is that once people get used to calling something by a particular name in federal assistance policy, they tend to stay with it for a long time. That's why people are still referring to the A133 audit instead of the Subpart F audit. That is the proper terminology going forward. Another set of definitional changes, though, is something to keep your eyes on. The term period of performance, budget period, and renewal all have to do with how the federal government commits appropriations to a particular time period. The period of performance may be a multi-year possibility. In other words, somebody applies for a grant and asks for a 3-year award. Well, what they're going to get is programmatic approval of a 3-year performance period, but they're going to get only a single budget period's worth of funds. So if you applied for a
I can't hear Bob.
Sorry, I'm working on it right now. Bob, if you can hear us, we can't hear you.
Am I back in?
Yes.
Where did we get cut off?
The period of performance multi-year.
Okay. All right, good.
Sorry, Bob. Thank you.
All right, good enough. Nothing like technology. Anyway, the multi-year situation might be a circumstance where you have applied for a discretionary grant from a federal agency. They programmatically approve you for that multi-year period, but when you get your grant award, you only get the year one money, and the funds for the remaining period of time are subject to additional scrutiny on the part of the awarding agency. So the budget period is really the critical aspect of this. Now, the term renewal has to do with the receipt of a brand new award. And so the manifestation of this in most cases, I think, will be whether or not you get a new document memorializing how much has been obligated to you for a particular budget period. But those terms are now something that OMB is establishing as the routine for federal agencies in handling this sort of thing. Management of exceptions is another issue, and we've had a significant amount of use of that during the coronavirus pandemic. The OMB memoranda that I referred to just a few minutes ago were all done under the rubric of OMB granting to itself the authority to grant exceptions to the requirements, unless those exceptions would collide with statutory law. In other words, OMB can't waive a statute, but something that wasn't statutory, they gave the authority to themselves to do that. And those memoranda are a case study in that sort of arrangement. Now, something else that has come along with the new requirements is required notice and comment on requirements that will be imposed on financial assistance awards. This is a manifestation of an executive order, Executive Order 13892, that President Trump issued, that has to do with federal agencies being required to establish that anything they add to a federal assistance award must be something that goes through a review and comment period. It doesn't mean that those items would be codified in the Code of Federal Regulations, but as I'm sure many of you are aware, things like guidance letters, internal policy documents in federal agencies and the like have a way of sneaking in to your grant agreements and perhaps adding additional burden. So, that's probably a situation that has been very welcomed by the recipient community. Revisions to federal agency responsibilities. Next slide. You might say, well, my eyes glaze over here and I really don't need to look at this. But on the other hand, I think if you look at it, you'll find some things in these sections that, again, will affect how federal agency personnel are going to behave, particularly in discretionary awards, where they're deciding, what the solicitation document, such as a notification of fund availability or a federal funding opportunity announcement, things like that, what they're going to be putting into those things and how they'll conduct review of your application. One of the acronyms you unfortunately will need to get familiar with is something called FAPIS, the Federal Awardee Performance and Integrity Information System. This is a repository available to all federal agencies that has to do with the record of performance by specific recipients. And entries into FAPIS are put there because they generally are negative matters. And so an entry in FAPIS is something that can be harmful to an organization that's applying for federal funds, because the federal agency involved may see some things about past performance that give them pause about whether to award funds or not. Now, there's a lot of due process associated with FAPIS, so federal agencies aren't supposed to put a bunch of stuff in there that is challengeable. But nonetheless, it's a concept that has been memorialized into CFR 200. The next slide deals with Section 889 of the McCain National Defense Authorization Act for 2019. I doubt that a lot of you have to contend with this, but there is a new section of 2 CFR 200, it's Section 216, which prohibits organizations from obtaining telecommunications services and equipment from a number of firms located in China. Now, again, this is something that is effective not only for grantees, but for the federal government itself and for federal contractors. It's created a significant stir in, again, those organizations that perform internationally. But the basic requirement that you see in the regulation is something that reflects essentially the statutory requirements that were enacted in that statute. Now, moving on to the next slide, post-award issues. There's certainly more renumbering that's taking place. A number of enhanced public policy requirements that are attached to your awards going forward. Most of these come out of executive orders that President Trump has issued, primarily in the areas of free speech and religious freedom. The kinds of public policy requirements that you're familiar with are ones that deal with non-discrimination, environmental protection, and the like. These have been added because of the president's authority to issue executive orders that don't conflict with federal statute. OMB says these have to be incorporated into awards. Other changes that were urged by organizations, primarily in the state and local sector, having to do with payment and programmatic and budgetary changes, are matters that OMB chose not to deal with. Now, moving over to procurement, the next slide. Here's a place where OMB's policy matters probably collide very extensively with reality. There are two kinds of purchasing methods that are discussed in the procurement section of the revision. OMB refers to both of these as informal methods of procurement. One is called a micro purchase. The other is called a small purchase. Now, micro purchase is a purchase that does not require competition because it involves less than a specific dollar amount. The micro purchase threshold in 2 CFR 200 has migrated up since 2014. Initially, it was $3,000. Then in 2015, it went up to $3,500, and then it went up to $10,000 as a result of statutory law that Congress enacted in 2017. Now, what that means is that an organization like yours can have a micro purchase procedure below that dollar threshold. My experience with a lot of organizations like yours is you already do. In other words, this is authority to move up to $10,000 if your governing body is comfortable doing that. But the idea that this is something that is essentially a sole source, non-competitive procurement arrangement is what's at work here. Now, statutorily, Congress enacted a provision that said that a non-federal entity could ask for an even higher threshold of up to $50,000 if their cognizant agency for indirect cost approved it and they met certain criteria that were primarily driven by the absence of audit findings in their previous 2 audits. These provisions were enacted at the behest of the college and university sector. They are not ones that were specifically sought, at least as far as I know, by governmental units, and they are probably not ones that are going to be easily adopted by governmental units. But that's the procedure that exists in that situation. Now, the other informal method of purchasing is what's known as a small purchase. And I've provided you with the citations to these requirements as they currently exist. The federal government says a small purchase is a purchase of an amount less than what's called the simplified acquisition threshold. That threshold is established in the federal acquisition regulation, and it's $250,000. That's the only place I know of where $250,000 is considered to be small. So once again, your own organizational policy is going to be what drives this. You've got some room, if your organization chooses to ratchet that upward. But remember that in a small purchase situation, you've still got to get offers from a reasonable number of sources. That's the term that's used. A lot of people think that there's something in the federal rules that says you got to get 3 bids. There's no number like that articulated. It says a reasonable number of sources, and a lot of organizations choose 3 as the basis for their policies. So what I'm suggesting to you is that maybe your purchasing manual deserves a little bit of an examination to see whether migration of dollar thresholds for micro purchases and small purchases might be warranted. But quite frankly, I don't see many organizations getting anywhere near the numbers that OMB has now published. Now, not surprisingly, again, because of an executive order that President Trump issued, there is a discussion in the new requirements for domestic preference. I've included the language from that section because, as you'll see, it has a certain amount of flexibility built into it. As appropriate and to the extent consistent with law, the non-federal entity should, not must, to the greatest extent practicable under a federal award, provide preference for purchase and acquisition of goods, products, and materials produced in the United States. There's a certain number of back doors there, but notwithstanding who wins the election, I think domestic preference is going to be something that continues to show up, just like it did in the American Recovery and Reinvestment Act back during the Obama administration. Now, as I told you earlier, closeout is something that's gotten a great deal of attention, and the next slide captures this. There have been numerous GAO reports to Congress about slow closeouts. That resulted in Congress enacting something called the GONE Act, Grant Oversight and New Efficiency Act. And what is primarily involved with that act has to do with federal government agencies having to report outstanding closeouts that they haven't accomplished. Well, as you, I'm sure, are well aware, when federal agencies get hammered on something, things start to roll downhill in your direction. And emphasis on timely closeout is a manifestation of that. Now, this might. Well, okay. Now, this might be surprising in the sense that revised deadlines for closeout actions have actually been extended. Those of you who are familiar with current closeout requirements, organizations are expected to submit their final financial and performance reports within 90 days after the end of their performance period. OMB is extending that by 30 additional days for recipients. I think what that suggests is that they're more tolerant of organizations having to take care of the things that are involved during closeout. But then once that deadline is up, things are going to get a lot more serious. As far as subrecipients are concerned, they've introduced themselves into that discussion and said that subrecipients are to close out within 90 days or earlier if agreed. Now, I think the problem there is subrecipients are going to be subject to some of the whims of pass-through entities trying to shorten that time frame even more. So be prepared for that kind of possibility. Finally, federal agencies themselves are given a year from the time they receive final financial and performance reports to accomplish the work that they must do. And there's some fairly squishy language there that gives them a lot more flexibility than recipients or subrecipients. Finally, OMB did not address the problem of slow closeouts that are having to do with the determination of final negotiated indirect cost rates when an organization has the provisional final methodology, where you get a rate at the beginning of your fiscal year, and then at the end of the year, you recalculate the rate based upon your actual costs, and you submit that to your cognizant agency, and then you wait for them to get back to you to finalize those rates and to be able to submit final claims. Now, as I told you earlier, one of the big deals that OMB dealt with that came out of the problems that surfaced based on the original 2 CFR 200 related to something called the de minimis indirect cost rate. And this concept came from behavior that had been present in the U.S. Department of Health and Human Services for many years. In a nutshell, when an organization came into HHS and applied for a grant for the first time and didn't have an indirect cost rate, what HHS did was they gave them an award and let them charge 10% of the modified total direct costs of the award until they came in with a grant with an indirect cost rate proposal and actually got a rate, in which case they would transition to the rate that was calculated. In other words, it was giving them a certain amount for their indirect costs with a recognition that the likelihood would be that they'd ultimately be able to claim a higher number. That's where the term de minimis came from. Well, when OMB issued 2 CFR 200, it offered the de minimis indirect cost rate to organizations that had never had a federal NICRA before. In other words, the same kind of situation that I just alluded to at HHS years ago. Well, that didn't take care of a lot of organizations. And so OMB has expanded the use of the de minimis indirect cost rate to others, including organizations that have had a gap in funding. So maybe an organization had some federal grants for a while and had an indirect cost rate and then ratcheted out of getting federal funds. And when they came back in, they didn't have an indirect cost rate and couldn't get one until they negotiated one with a cognizant federal agency. So the idea would be that those organizations would now be eligible for the de minimis rate. And thirdly, organizations that simply elected the usage of the de minimis rate in order to stay out of the business of negotiating rates, which involves a certain amount of burden in terms of the back and forth between the recipient and the federal cognizant agency. Now, the other really important thing that OMB did about the de minimis rate is they clarified the fact that if an organization is using the de minimis rate, they do not need to prove costs under this method. In other words, the de minimis rate becomes what amounts to a deemed amount of federal funds recovered for indirect costs. I guess the best way you can think of the de minimis rate is think of it in the same context as a per diem for meals and incidental expenses when you travel. You know, if you get a per diem, that's what you're going to get, regardless of how much you spend on meals and incidental expenses. So, you know, you don't have to bring back any receipts when you have a per diem kind of an arrangement. Well, you don't have to show any receipts in order to charge the de minimis rate. Now, closely related to that, over on the next slide, is activity related to pass-through entities and indirect cost. There are a number of scenarios that have surfaced in the interim period of time since 2 CFR 200 came out, particularly involving organizations that don't have a direct relationship with the federal government and therefore can't get a negotiated rate, indirect cost rate from the federal government. A lot of subrecipients are in that mode. Well, 2 CFR 200 established that pass-through entities would be responsible for negotiating rates with those kinds of organizations. Here's where the problem comes in, and we'll get specific, I guess, here. Let's say that a subrecipient comes into state agency A and submits a grant application and includes in that grant application an indirect cost rate, which they've calculated. And state agency A reviews that information and says, yeah, we'll accept that rate, and you can use it on the award that we're giving you. Well, then that subrecipient goes over to state agency B and says, here's a grant application. And oh, by the way, state agency A negotiated an indirect cost rate with us. We'd like to use that on this award. And state agency B says, we're not going to let that happen. We haven't reviewed that rate. We're not going to go along with that. And so subrecipient is between a rock and a hard place. Well, OMB heard a lot about all those kinds of scenarios and finally established in the new rules that it's possible for other pass-through entities to accept rates negotiated by others. The key thing is they're not required to. They are simply permitted to. And that's why I've suggested here on this slide some possible best practice considerations. Perhaps what would make this work a whole lot better would be for the subrecipient, again going to state agency B, to certify, using the certification that's in these regulations, that their rate was calculated in accordance with the requirements and going on record for that. You know, another thing for the finance officer of that organization to stick their neck out on, but you know, perhaps with good reason. Secondly, for the pass-through entity to issue a federal type rate agreement, the type that would be issued by a federal cognizant agency. And there are numerous examples of that in the appendices, as well as the guidance material that's talked about in the appendices. And as part of that, a statement by the pass-through entity stating that it used procedures established in 2 CFR 200 in arriving at the calculation. Arguably, the presence of those features would provide reasonable assurance to our state agency B that the calculation of indirect cost was accurate. Now, one other issue related to negotiated indirect cost rate agreements. OMB proposed to post federally negotiated NICRAs, as they're termed, on the internet. And boy, did they get some comments about that. And so they backed off of their original proposal, which would have provided a significant amount of proprietary information about organizations who have federally negotiated rates. Instead, what they've said they're going to do, and they haven't done it yet, they're busy with a lot of other things, is to post NICRAs on a federal website, but to limit the data elements to the indirect cost rate, that is what percentage is involved, the distribution base, whether it's modified total direct cost, salaries, wages, and fringe benefits, or salaries and wages, and the rate type, whether it's provisional, final, predetermined, or fixed with carry forward. Again, this is responsive to the fact that the Federal Freedom of Information Act applies to proprietary information, among other things, and says that that kind of stuff can't be disclosed. Well, the information that will eventually show up on this website is not deemed to be proprietary. Just a few more slides before we go, hopefully, to a few questions or comments. The cost principles in the audit section were largely left intact. There's more renumbering, but that's an unfortunate circumstance. One thing, though, that is new and is worth mentioning is the provision that shows up in 200-403, which says that in addition to costs being necessary, reasonable, allocable, consistently treated, all those sorts of things you've heard about over and over again, the costs must be incurred during the approved budget period. Now, incurred means that it can be accrued as opposed to dispersed for, but that it must be circumscribed by the budget period. And so that's where that definition becomes particularly important. There's a new section in 200-414, which deals with what I just covered and public information related to negotiated indirect cost rate agreements. And there's a new section related to telecommunications costs, which establishes that those costs are allowable, but carves out the prohibited items that are referred to in 2 CFR 200-216, which had to do with these Chinese companies that are providing equipment or services that have the potential for adversely affecting national security. Finally, OMB clarifies something that I wasn't sure was a big problem, but they apparently did, that pass-through entities are not responsible for resolving subrecipient audit findings that relate to financial statements. Audit resolution for pass-through entities is confined to information related to the expenditures on the schedule of expenditures of federal awards, the CFA, that relates to the funds they've provided. The appendices to 2 CFR 200 are lengthy and diverse. Part of the reason why they're there is because they don't lend themselves to incorporation within the regulation itself. But for example, Appendix Roman numeral 1, the full text of a notice of funding opportunity, that's the kind of stuff that shows up in grants.gov when you're looking for a grant opportunity. There's lots of editing that took place there, not the least of which has to do with the abandonment of the CFDA designation. Appendixes Roman numeral 3 to 7 are where the indirect cost recovery procedures are presented by sector of performer. And so Roman numeral 5, 6, and 7 are the ones that apply to governmental entities. If your organization is considered to be a nonprofit entity as opposed to a governmental entity, then Roman numeral 4 is where that shows up. And finally, Appendix Roman numeral 11 is the compliance supplement. And I like to refer to the compliance supplement as the Cliff's Notes of grants administration. It's what you're going to be tested on. It's not just for auditors. Well, if we turn over to the next slide on Appendix 11, it was released on August 18th. It's effective for audits of fiscal years beginning after June 30th, 2019. So those of you who had a fiscal year close of June 30, 2020, this is the supplement your auditors are going to be using. But as I pointed out earlier, the main document has been brought out, but this future addendum, which is slated to come out later on this month or early next month, deals with the funding that came along in the CARES Act. And so some of the major issues that the compliance supplement will address is how CARES Act funding will be addressed in your schedule of expenditures of federal awards, the differing requirements that occurred related to those OMB memoranda that I dealt with earlier, and the fact that there may be some differing requirements for COVID-19 sources of money and regular funding under the same CFDA numbers. For example, the Community Development Block Grant Program received supplemental funding under the CARES Act, but also the awards were being made under existing authority, which we might call regular funding. So these are some of the shoes that still need to drop related to all this. Now, just a couple of comments about the other sections of Title II of the Code that were revised. 2 CFR 25 again deals with registration on the system for award management and the issuance of a unique identifier. OMB has adjusted the exemptions in the regulation where it is difficult to have an organization register with SAM. And this is primarily dealing with foreign entities, particularly those whose involvement with federal programs might put them at risk. There's a broader definition of federal financial assistance, meaning that loans and loan guarantees, organizations being involved in those types of programs will have to register with SAM as well. And there's an updated standard clause that you will see showing up after November 12th related to this particular requirement. Finally, the requirement for SAM registration flows down to subrecipients. So if you're getting funds directly from the federal government or through a state government, and you're turning around and subawarding to somebody else, them having a SAM registration is important. Over to the next slide, 2 CFR 170, a differing clause there as well. The major change that occurred in that regulation is that subaward reporting has been raised to cover obligations of $30,000 or more. Those of you who are familiar with that requirement in the past, the number was 25,000. So anytime an organization made a subaward of $25,000 or more, they were required to report it to usaspending.gov. OMB has bumped that up to 30,000, and I quite frankly am not sure how many awards that really saves in terms of reporting. Now, the last thing I want to mention before we go to questions and comments is to suggest to you a list of things that I would be doing if I were in your shoes. Get fully caffeinated and read the Federal Register announcement of August 13th. Keep an eye on federal actions, particularly federal notices that occur between now and November 12th, and be on the lookout for that compliance supplement addendum. Don't leave that up to your auditors alone to understand what's there. And then take a look at some of your existing procedures, particularly in the procurement area and in the indirect cost area. I think that some of the changes that are involved there bear some attention. And in particular, obtain some clarity about what closeout procedures are going to be from pass-through entities that you're getting funding from. State agencies that you deal with are probably going to be getting a certain amount of pressure from their awarding agencies to deal with this, and knowing what the expectations are going to be and whether they are practical and doable is going to be something that will play out. Finally, the last slide suggests that there's some areas for continued engagement, whether individually or through your associations. OMB made a commitment to consulting with stakeholders and making possible additional changes. Ask for a place at the table on this sort of thing. One of the things I've noticed, particularly in how these changes have played out, is that the associations that represent higher education institutions have been extremely active in providing input to OMB, even when they weren't asked. And in addition to that, the National State Auditors Association and the American Institute of Certified Public Accountants have been go-to parties when it had to do with some of this audit policy. So, there's no reason why NARC and TARC and other organizations that you are members of can't be part of the players that bring to OMB's attention some things that need to be fixed. Because while this document is really something that did improve a lot of things, there are still some warts on it. Nothing's perfect, and continued progress and improvement is something that's warranted. So with that, let me turn it back over to our hosts, and I suspect there may be a few questions that were put into the chat pod or have been brought up, so I'll try to address those. If we don't get to all of those, somewhere in the slide deck is some contact information with my email and my telephone number, and I'll be glad to field those later on if that's the most appropriate way.
Great, thank you so much. Really appreciate all the information you've provided today. Nancy, do you want to jump in and say anything before we go to a quick question or two?
Sure. Some of you have requested how would you get CPE credits for this presentation, and the Houston-Galveston Area Council will coordinate that for you. If you'll send an email to my assistant, Marsha Porter, with the information on this slide, which we need your name, your organizational name, your email address, and your phone number, and we will work with the Texas Association of Regional Councils to get you your CPE credit for this. Bob, I found your discussion very interesting, and I will pause while others ask questions, but I have a few of my own.
Okay.
So if you want to ask a question, feel free to either enter it into the chat box and I'm happy to read it for you, or you can unmute yourself and ask a question if you would like. Well, hearing none at the moment. Oh, go ahead.
Nancy, do you want to go ahead and,
I will.
pierce the silence?
Okay. I want to ask about subpart C. And specifically, does that pass through to subrecipients?
Subpart C?
Yeah.
No, it doesn't. It's the federal government's responsibilities. That's why I call it. I mean, it's NARC would title pre-federal award. So it's the stuff that a federal agency is supposed to do in preparation for making an award to a prime recipient.
Okay.
The stuff that applies to pass-through entities and their dealings with subrecipients are currently contained in 2 CFR 200-330 to 332. And a lot of what's in there mirrors what the feds are supposed to do to prime recipients, or I shouldn't say do to, but maybe that's a Freudian slip. But basically, pass-through entities have a similar set of duties in the pre-award stage to determine the nature of the relationship, to do a risk assessment, and to write an agreement that flows through the proper terms and conditions to the subrecipient. And then section 331 of the reg goes on to describe what kind of subrecipient monitoring is expected. And that's divided up into a set of mandatory steps that must be taken vis-a-vis everybody, every subrecipient, and then a bunch of discretionary steps that a pass-through entity can use if it wants to. So again, it kind of shows this differential accountability that I alluded to earlier. I mean, there's some things that a pass-through entity has to do to all of its subrecipients, but there's a whole bunch of other things that are discretionary.
I have one more question. Thanks, but I have one more question. You talked about FAPIS, and I was wondering, is that available to non-federal entities to see and review, or is it just federal? For instance, could COGS see what's entities that are have negative comments about?
Right. Well, yeah, there is the regulation on this is one of the more lengthy sections because of the due process associated with it. I mean, essentially, if a federal agency enters some stuff in FAPIS, the party about whom that entry is placed has a right to review what's there and to challenge it because of the possibility that adverse information would be posted and it wasn't fairly done. Now, the question of general public access to FAPIS, I think, and that would be an issue that a prime recipient might be looking for a subrecipient on. I don't think that at this point it's been opened up to that extent.
Okay. All right. Well, those were a couple of my questions. Thanks.
Great. Well, I do see we're at the end of time. So does anybody have any really quick questions before we end?
Well, again, it may be that there are some that they don't want to share with the group, which is fine. Again, I'll be glad to entertain those offline at some point. If you do, I talk faster than I type, so the telephone is probably a good way to get in touch with me. Just say that you were an attendee at the regional council program on October the 8th, and I'll know you're legitimate, and then I'll call you back.
Thanks so much, Bob.
Great, thank you. And
Appreciate
thank you all for joining today. Thank you, Nancy, for sponsoring this with HGAC, and thanks to TARC for sponsoring the continuing education credit. So really appreciate you both, and thanks, Bob, and hope you all have a great afternoon. Thanks for joining us.
Bye-bye.
Thank you.
Goodbye.
Thank you.